Malcolm Ethridge is a CNBC contributor and executive vice president at CIC Wealth, and Ron Insana joins us as well. He is, of course, a CNBC senior analyst and commentator and co-CEO of Contrast Capital Partners, and so much more.
Or less.
Or less, whatever. Malcolm, let me start with you. Why is it concerning, or why should we be concerned, that the leadership in the market seems so narrow?
Yeah, Tyler, it's concerning because when fewer stocks across each sector are participating in that rally, it means the rally is more likely to fizzle out and the market's more vulnerable to a pullback, right? And this is coming from someone whose own personal portfolio over indexes toward tech. So I'm very happy to see the S&P up being carried by these names, but I'm also very concerned when we only see 3 stocks doing all of the heavy lifting because there's no way to get out of the way when the trade goes the other direction.
You share that view, Ron?
To a point, although we've seen, the market breadth expand a little bit, and so there's been what some technicians like to call a bit of a breadth thrust. So you've had,
okay,
yes, that's what they call it. That's a
okay.
technical term. But yeah, I mean, I think my bigger concerns are really around not so much the narrowness of the advance, but what the headwinds are still facing the market, whether it's earnings, whether it's the Fed, whether it's a misread on inflation, which I think is still taking place. I think those are even more profound issues for the markets going forward.
Malcolm, let me turn back to you on earnings. We're going to start getting some of those bank numbers. I believe it's tomorrow, actually. One of the areas that is sort of stands out to me is what the banks will say about loan origination and the tightening of credit standards and what that could mean not only for the stocks and the market, but for the economy.
Yeah, I can imagine that the bank CEOs are going to want to tell us everything about how well capitalized they are, how well diversified their customer mix is, just trying to separate themselves from the contagion of an SVB and Signature and everybody else that we're so concerned about and have been so concerned about for weeks. They're finally getting their moment to come out and talk about why they're different. This is the GSIBs that I'm talking about. But I think, to your point, what's more important is just how little they're lending now because they're having to tighten lending standards. At the same time, deposits have been fleeing from at least mid-sized and community banks where, on one hand, we have to worry about our long-dated bonds coming back to bite us. And also now we can't lend because lending standards have to be tighter and rates are significantly higher. So the big 6 banks I know are going to be in good shape. They probably weren't lending all that much to begin with in this space because they traditionally lend less in small and mid-sized business arena than the local banks. And that's for good reason because so much business is hyper-local. But I think that they're going to want to focus the majority of the conversation on the details that don't really matter too much to us as investors, but they'll want more time. They'll want to reassure investors one more time that their banks aren't exposed in the same ways.
Malcolm, as a quick follow-up to that, I see that you are to some extent expecting more weakness at Charles Schwab, but also using that as a buying opportunity and think others should as well. Why?
Yeah, so I actually bought into Schwab on weakness because I think 31% down is where we first got. We broke through its 52-week low and established a new one. We're now, 40% or so off of its highs. To me, Schwab is a brokerage masquerading as a bank, right? It's a brokerage first and a bank second. And I think that's gotten misunderstood by investors a little bit who are looking at the $333 billion or so of long-dated bonds that are on their balance sheet that during their earnings next week, they're probably going to tell us are worth something with a 2 handle on it. But I think that's a mistake to focus solely there simply because they have liquidity in other places that they can tap into and allow their long-dated bonds time to maturity, right? In these types of circumstances where we have a Schwab who's a brokerage with a bank, higher interest rate periods like this one are actually a big wind at their backs, right? They are able to lend against and make money on the cash that sits on deposit between trades from all of their retail brokerage clients.
Ron, should the Fed hold in May and go away?
They should have held in March or January or December. Yeah, look, I mean,
what's the old cliche?
Sell in May and go away.
Sell in May and go away.
Yeah,
they hold in May. That's what I was.
Yeah, you sell Rosh Hashanah, you buy Yom Kippur. I don't know. We can do this all day. I mean, but look, I think we just got the 9th straight month in which wholesale inflation came down. We peaked at 11%. Today's 2.7% year over year. I am a broken record on this, as you both well know. And all the data, with the exception of oil, which is
People
extraordinarily
don't know what
volatile.
records are, Ron.
I'm sorry. I'm a broken Spotify.
You're a broken wheel.
Broken stream.
The wheel of death.
I'm an unending stream. How's that?
Oh, that's good. Gotcha.
But, yeah, look, I mean, I don't know what the argument is. And again, the same people come up with the same argument, that there's still too much core inflation, there's still too much super core inflation, there's still too much underlying price pressures. And yet, when you look across every category, they've all come down markedly, and I don't understand, again, why they're so fixated on this in the way they are. I went back yesterday and looked at inflation data in post-World War II, post-World War I environments, which, again, I tend to think is more analogous to the 1970s. It took 4 years for inflation to go away, but those were two very, very big events that shocked the world. The pandemic was as well, and the war in Ukraine. I think it's going to take less time, and we're certainly already seeing that.
Yeah, already through those innings.
Yeah. All right, Malcolm, thank you very much. Ron and
That's
Sana.
it?
I think we're done.
All right.